You know, usually when we look at massive institutional portfolios, you expect to see hundreds of different stocks.
Right. Yeah. Like a little bit of everything.
Exactly. A little bit of this, a little bit of that. The classic diversification playbook.
Yeah.
Designed so that if, I don't know, one sector completely tanks, you don't lose your shirt.
Right.
But then you look at Chris Hahn and TCI Fund Management, and you realize they have, like, thrown that entire playbook completely out the window.
Oh, absolutely out the window.
We are looking at a $52 billion fund. And yeah, that is billion with a B stuffed into just 11 positions across 10 companies.
Wow.
And the top 5 of those, they make up over 84% of their total assets.
It is a stunning level of concentration.
Yeah.
They aren't just betting on the market in general,
Yeah.
They're making this massive, high conviction bet on a very specific type of business architecture. And it's one that has actually delivered an 18% annualized return since the fund's inception.
Which is just wild to think about.
Yeah, it really is.
So we're going to break down exactly what that architecture looks like for you today, because it honestly totally changes how you look at the everyday economy.
It really does.
But before we open the vault on, how they actually do it, I need to get through a quick piece of mandatory housekeeping. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Yeah, that's essential context for any deep dive. Always do your own homework.
For sure. And if you want to track this kind of high-level institutional maneuvering yourself, we actually have some great tools for you to check out. To access more advanced researches, follow Gurus' latest movement, and leverage our latest Deep Values agents, welcome to download the Deep Values app from the App Store. And to track stock market temperature, welcome to download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
Highly recommend those if you're, following along at home.
Definitely. All right, so let's jump straight into TCI's second quarter 13F filings.
Let's do it.
For anyone who doesn't obsessively track these, a 13F is basically the quarterly report card where big funds are legally forced to show the public what they're holding.
Right.
And seeing 84% of $52 billion sitting in just 5 companies is, it's wild.
It is. It really forces you to ask, well, what do those 5 companies actually have in common?
Right.
Because TCI evaluates public equities through this lens that you usually only see in private equity.
Yeah.
They're on this relentless search for what they like to call insurmountable structural moats.
Insurmountable structural moats.
Exactly. They want businesses that operate as indispensable toll booths on global economic activity.
Okay, so to understand what makes a perfect toll booth, we should probably start with what TCI absolutely refuses to touch, right?
Oh, yeah. The negative screen is crucial here.
Because they start with, the thousands of publicly traded companies out there, and they immediately throw almost all of them straight in the trash.
Yeah, they run a remarkably aggressive negative screening process.
Mm-hmm.
They narrow the entire global investable universe down to just 200 businesses.
200 out of thousands.
With just 200. They explicitly avoid sectors that are exposed to heavy commodity pricing, low barriers to entry, cyclical capital destruction,
right,
or heavy technological obsolescence.
Which basically wipes out, commercial banks, auto manufacturers,
traditional retail, airlines, yeah,
commodity extractors, legacy media. Basically, if a business operates in a competitive open market where they have to, constantly fight a price war just to keep their customers.
TCI's out.
Completely out.
They're just not interested.
No. They prioritize the width and the durability of a company's competitive moat over, say, its nominal revenue growth.
A business that's compounding its intrinsic value at moderate single digits is far more attractive to them, provided it has this impenetrable competitive position, than, some hyper-growth business that's fighting for its life every day in an open market.
I feel like it's kind of like playing Monopoly, right? But you're refusing to buy houses on the random properties.
That's a great way to put it, actually.
You don't want to manage a bunch of mediocre spots on the board. You only want Boardwalk, the railroads, the electric company.
Yeah, exactly.
You just want to own the places everyone is literally forced to land on.
Forced to land on, yes. Yeah. And the defining characteristic of those specific properties, like the secret to a perfect toll booth, is asymmetry.
Asymmetry.
Yeah. So the product or service has to be absolutely essential to a customer's operations, but, and this is key, it should represent only a tiny fraction of that customer's total cost structure.
Okay, wait, give us a tangible sense of how that asymmetry plays out in the real world.
Well, think about the pricing power that creates. If you provide a service that a massive corporation literally cannot function without,
All right.
but it only costs them, say, a fraction of a percent of their total operating budget, you have highly inelastic demand.
Because they're not even really noticing the cost.
Exactly. You can systematically raise your prices above the rate of inflation, like every single year.
Yeah.
The customer's procurement department will complain, sure.
They always complain.
Right. But they won't cancel the contract.
Yeah.
Because the cost of replacing you or, trying to function without you is astronomically higher than just paying your little price increase.
Okay, I want to test that theory against the actual heavyweight in this portfolio, because this is where it gets crazy to me.
Go for it.
A massive 33.59% of this fund, which is roughly $17.7 billion,
Yeah.
is sitting in a single company, GE Aerospace.
Yep.
Through their joint venture, CFM International, GE powers 3 out of every 4 commercial passenger flights globally.
3 out of 4.
Yeah.
It's staggering.
But wait, I have to push back here. We just said, like 2 minutes ago, that TCI explicitly avoids airlines because they are cyclical capital destroyers.
We did say that, yes.
So why are they dumping a third of the fund into airplane engines? Like, if people stop flying or airlines go bankrupt, doesn't GE take a massive hit?
You'd think so, but the structure of this specific moat is brilliant. Because TCI isn't betting on the airlines at all.
They aren't.
No, they are betting entirely on the aftermarket parts, the initial sale of that jet engine to the airline. It's essentially just an entry mechanism. It's the razor in the classic razor and blade business model.
Oh, okay, so they sell the engine at a lower margin just to get the plane up in the air.
Right, because once that engine is physically on the wing of a Boeing or an Airbus, it locks the airline into a 25 to 30-year annuity stream of really high-margin aftermarket spare parts, specialized components, and maintenance shop visits.
But if I own a car, right, and the dealer charges way too much for a replacement alternator or something, I just go to my local mechanic and buy a cheaper third-party knockoff part?
Sure you do.
Why can't a massive airline just source cheaper parts to save money on maintenance?
Because the regulatory environment makes that completely illegal.
Really?
Oh, yeah. Aviation authorities, like the FAA, issue strict airworthiness directives. Commercial airlines are literally mandated to buy certified parts directly from the original equipment manufacturer, the OEM.
Wow.
I mean, think about it. A jet engine turbine blade operates at temperatures that would melt regular metals, right? It requires highly proprietary engineering.
So no cheap knockoffs.
No. If an airline substitutes an uncertified alternative part or uses a non-approved maintenance protocol, they violate fundamental safety regulations.
And I imagine doing that would just immediately tank the resale value of the actual airplane, too.
It massively impairs the residual value of a multi-million-dollar asset. So GE's high-temperature materials engineering, combined with just the sheer weight of safety certifications, creates this impenetrable barrier.
So the airlines are basically a captive audience for 3 decades per engine?
Exactly. Because propulsion reliability is a literal life-or-death mission-critical requirement.
Yeah.
Airlines just have to accept those recurring price adjustments.
They give you the engine to get you hooked on 3 decades of mandated maintenance. That explains why the sources show these long-term service agreements generating returns on invested capital well above 25%.
It's a legendary toll booth.
Okay, so GE is a physical toll booth, but their second largest holding acts as a toll booth on almost every transaction we make, right? Visa.
Oh, Visa.
Yes. It makes up almost 20% of the portfolio. That's about $10.4 billion.
Visa is fascinating because it operates on a two-sided network effect that is nearly impossible to replicate today.
How so?
Well, on one side, you have billions of consumers holding Visa cards, expecting to use them everywhere. And on the other side, you have millions of merchants who absolutely must support the Visa network, or they risk turning away all those paying customers.
Right. You don't want to be the store that says, we don't take Visa.
Exactly. For a new competitor to build an alternative global settlement network with that level of security, regulatory compliance, and universal acceptance, the capital cost alone is an insurmountable barrier.
What really stands out about Visa in the context of TCI's strategy, though, is its built-in inflation resistance.
Yes.
Like, Visa captures its assessment and transaction fees as an ad valorem percentage of the gross payment volume.
Right. Ad valorem, simply meaning that the fee is tied directly to the value of the transaction itself, rather than being a flat, fixed rate every time you swipe.
So, okay, think about your daily life. If inflation drives the price of your regular lunch sandwich from, say, $10 to $15.
Visa automatically makes more money when you swipe your card.
Exactly. And they don't have to build a new factory to handle that $15 sandwich.
Nope.
They don't have to buy more inventory or hire more workers. Their core digital infrastructure just scales with near zero marginal cost. It is like the ultimate inflation-resistant toll gate on personal consumption.
And when a company has a near zero marginal cost to process higher revenues, it translates into just staggering capital efficiency. Visa consistently runs operating margins above 65%.
65%.
Yeah, and their returns on invested capital routinely exceed 40%.
Okay, so Visa is the toll booth for consumer spending, but corporations also need a toll booth, especially when they need to borrow money.
They certainly do.
Which brings us to over 23% of TCI's portfolio parked in the credit rating duopoly. We're talking Moody's at 12.3% and S&P Global at 10.87%.
Now, the moat here is forged out of pure regulatory mandate, because Moody's and S&P Global aren't just selling financial data.
Right.
The SEC officially designates them as nationally recognized statistical rating organizations, or NRSROs.
Okay, but for a company or a government trying to actually raise money, what does that designation even mean?
It means they are indispensable to the flow of global capital. Think about the massive institutional fixed income investors out there, the state pension funds, the global mutual funds.
Yeah.
These institutions are legally, or at least mandatorily constrained by their own internal charters from purchasing unrated debt.
Oh, I see.
So if a corporation wants to issue $1 billion in bonds to build a new facility, they need those pension funds to buy the bonds. And to access that debt market, they have to get an official rating.
It's basically a bouncer at an exclusive VIP club.
That's a perfect analogy.
The corporations have to pay the bouncer to get into the debt markets, and they literally don't have a choice. If you don't pay Moody's or S&P for that little stamp of approval, you just don't get in.
The bouncer analogy is spot on. And the pricing power this setup creates, it brings us right back to that concept of asymmetry we discussed earlier.
This tiny fraction of the cost thing?
Exactly. The fee a corporation pays for a rating is a tiny fraction of the total cost of underwriting the bond. We are often talking about less than 5 to 10 basis points.
Okay, let's translate that math for a second. A basis point is 1/100%. So 5 basis points means for every $1,000 a company is borrowing, they are paying Moody's literally pennies.
Literally pennies. But those pennies buy them an investment-grade rating, which significantly reduces the interest rate the company has to pay to borrow the money over the next 10 or 20 years.
So the rating effectively pays for itself.
It drastically lowers the issuer's cost of capital.
High value provided for a relatively small required fee.
Exactly. And because of that massive asymmetry, Moody's and S&P can implement annual price increases of like 3 to 6% across all economic cycles.
And the customers just take it?
The issuers might complain about the rising cost of ratings, sure, but they will never stop buying them because they legally have to have them. And just like Visa, this is an incredibly asset-light business.
Right. They don't have factories.
Rating agencies require negligible physical capital, mostly just analysts and computers, which leads to operating margins that regularly surpass 50%.
We're definitely seeing a very clear pattern here. Asset-light, high-margin, inescapable businesses. But that pattern makes the most shocking part of their second quarter filings so bizarre to me.
Oh, the Q2 pivot, yeah.
According to the 13F, TCI completely liquidated its long-standing position in Microsoft.
Completely.
They sold their final 2.7 million shares, freeing up over $1 billion in capital.
It's a complete exit from one of the most dominant enterprise software and cloud computing companies on the planet.
Why?
Well, the sources indicate this massive rotation was really driven by fears regarding artificial intelligence.
Okay.
Specifically, the expanding capital expenditure requirements to build out AI infrastructure might compress Microsoft's near-term free cash flow. Hyperscale AI computing requires continuous massive investment in data centers and specialized chips.
Okay, but so they dumped the ultimate AI and cloud giant.
Right.
And they put $1.48 billion into rocks.
Quite literally, yes. They took that capital and initiated simultaneous new positions in Martin Marietta Materials and Vulcan Materials, which together formed the North American aggregates duopoly. They mine and produce crushed stone, sand, and gravel.
Walk me through this because I'm genuinely bewildered. We go from the cutting edge of artificial intelligence, high-margin cloud software, to literally digging gravel out of the dirt.
It sounds crazy.
How on earth does that fit the TCI philosophy?
The brilliance here is that crushed stone represents the ultimate spatial
My
monopoly.
spatial
Yeah,
monopolies.
think about the physical properties of gravel. It has an exceptionally high weight-to-value ratio. It's incredibly heavy, but a single ton of it is relatively cheap to purchase.
Okay, so the product itself is cheap, but moving it is an absolute nightmare.
Exactly. The transportation mechanics dictate the entire industry. Because a truckload of gravel is so heavy, burning diesel fuel to haul it becomes entirely prohibitive if you try to move it beyond, say, a 25 to 50-mile radius from the quarry.
Oh, wow. So if you own the active quarry near a rapidly growing metropolitan city, you effectively own a localized monopoly. Like, a competitor can't just mine gravel 100 miles out in the country and truck it in to undercut your prices because their shipping costs would completely wipe out any potential profit.
The physics of transportation build the moat for you.
That is genius.
Right. And on top of that, developing new quarries near growing cities is nearly impossible today. You face intense municipal zoning resistance, incredibly strict environmental regulations, and just a general scarcity of commercially viable rock deposits.
So nobody is building new ones.
No. An existing permitted quarry is a structural moat made of actual stone.
But do they actually have pricing power on gravel? Like, can they raise prices like Visa does?
Oh, remarkable pricing power. Aggregates are an essential, non-substitutable structural component in concrete, asphalt, and road base. You physically cannot build a new highway, a massive new AI data center, or a residential subdivision without thousands of tons of it.
Right.
And yet the cost of the gravel usually represents a low single-digit percentage of the total construction project cost.
Ah, the asymmetry strikes again. It is structurally essential to the project, but just a blip on the overall budget.
Exactly. The average unit value of construction aggregates has climbed from $11.60 per ton in 2020 to $17 per ton in 2025.
Wow.
They systematically increase unit prices per ton, passing all inflation costs directly onto the builders, even during periods when overall construction volumes soften. This localized pricing power generates cash gross profit margins exceeding 60%.
Okay, but a spatial monopoly on heavy rocks doesn't mean much if you don't own the infrastructure to move heavy goods long distances, right?
True.
Which perfectly explains why TCI has parked nearly 10% of the portfolio into railroads.
Hi,
Specifically Canadian Pacific Kansas City, or CPKC and Canadian National Railway.
Railways are another masterclass in non-replicable assets. They own contiguous, unbroken rights-of-way that span the entire continent.
You physically cannot build a competing railroad today.
No, it's impossible. The land assembly costs, the environmental zoning, trying to acquire the land through crowded cities, it's economically and legally impossible.
And if you are shipping heavy bulk freight-like grain, industrial chemicals, automotive goods, you don't really have an alternative.
Right, because moving heavy bulk freight by rail is 3 to 4 times more fuel efficient and significantly cheaper per ton mile than long-haul trucking.
Wow, 3 to 4 times.
Yeah, this enduring physical cost advantage gives them immense pricing power. Shippers are captive to the existing rail lines. Furthermore, their long-term shipping contracts feature dynamic fuel surcharge mechanisms.
Meaning what, exactly?
When global energy costs spike, the railroad doesn't absorb the loss. They just automatically pass that inflation directly onto the shippers, completely protecting their operating profit margins.
Speaking of transportation and dynamic pricing, the most fascinating infrastructure play here has to be their 2.72% position in Ferrovial.
Oh, Ferrovial's fascinating.
Right. They manage express toll lanes, mostly in Texas and North Carolina, and the pricing model they use is just wild,
They utilize algorithmic congestion pricing.
which basically means the toll road is functioning like Uber surge pricing, right?
Exactly like that. Instead of a flat, predictable toll rate, the rates adjust automatically every few minutes based on the real-time traffic density.
That is crazy.
The contractual goal is to guarantee a minimum vehicle speed in the express lane. So during peak commute periods when the main highway is literally a parking lot, the toll rates in the express lane increase substantially.
And people pay it.
Commercial fleets, delivery trucks, or just regular drivers who are willing to pay a premium use the lanes to bypass gridlock.
And the kicker here, according to the sources, is that some of these contracts operate without statutory rate caps.
None at all.
They can just effortlessly outpace inflation by letting the algorithm charge whatever the market will bear. If traffic gets heavier, the price just scales up automatically.
It is a dynamic toll booth in the most literal sense. And once the capital-intensive construction of the physical lane is finished, the ongoing maintenance costs are minimal. This allows them to convert a massive percentage of those surging toll revenues straight into bottom-line earnings.
Okay, so we've covered physical coal booths, but that actually directly bridges to the remaining major holding, which operates as a digital toll booth, Alphabet.
Yeah, Google.
It sits at 8.32% of the portfolio when you combine the two share classes. But Alphabet's Google Search and YouTube feel a world away from railroads and gravel.
On the surface, sure, but the underlying mechanism is identical to Ferrovial. Alphabet operates exactly like a dynamic toll lane, just in the digital infrastructure space.
Because of the ad auction.
Yes, Google Search operates a real-time, dynamic auction advertising marketplace.
Right.
Think about a local plumber bidding on the search term emergency pipe repair. As underlying consumer prices rise with inflation, that plumber charges more for a house call, which means they have a larger nominal advertising budget. Because they are competing against other local plumbers, the competitive bids for high-intent search queries rise automatically. The auction model functions as an automated, invisible pass-through for inflation.
So Alphabet captures the increased value of commercial intent without having to do any extra work.
None.
The marginal cost of running that search query remains near zero, much like Ferrovial captures the value of bypassing physical traffic without having to build a new road.
The mechanism is exactly the same. They own the indispensable infrastructure, and the customer sets the price higher through competition.
When you step back and look at the totality of this portfolio, it really reframes how you look at the world.
It really does.
Like TCI's strategy isn't about chasing the hottest tech trend or gambling on a turnaround story. It's about finding the inescapable choke points of the modern economy. Whether it's the aftermarket parts keeping jet engines in the sky, the digital payment networks processing our groceries, the legally mandated ratings on corporate debt, the transnational railroads, or literally the crushed stone needed to pave a new highway. They only invest where the customer has absolutely no other choice but to pay the toll.
That is the absolute essence of their success. They hunt for natural spatial monopolies and insurmountable regulatory or physical barriers. These moats allow the companies to endlessly raise prices above inflation, securing that 18% annualized return.
It's brilliant.
It is. But, as an observer of the broader economy, reading through these sources actually raises a really compelling question to ponder.
What's that?
Well, we've established that these are perfect business models for an investor, right?
Sure.
But when every essential function of society, from how we search for information digitally, to how we pay for our goods, to the physical pavement on our roads and the railways moving our food, is controlled by an inescapable profit-maximizing toll booth. At what point does that perfect business model become an unsustainable burden on the rest of the ecosystem?
Wow. That is a fascinating thought experiment to leave on. A portfolio of perfect monopolies is undeniably great for the returns, but it certainly makes you look at the infrastructure around you a little differently the next time you pay a toll or swipe a card.
For sure.
Thank you so much for joining us on this deep dive. We encourage you to keep questioning the hidden mechanics of the economy around you. And don't forget to check out the recommended apps like the Deep Values APP and the Buffett Indicator to continue your own research journey. We'll catch you next time as we keep exploring the forces shaping our world.